Let me introduce him. Rakesh is a qualified chartered accountant. He qualified as a CA in 1996. He has been working for Reliance Industries for past about 1.5 years. He is Vice President, lead accounting expert for all the entities. Basically, he is knowledge, head in that sense as far as accounting is concerned. And I have covered various businesses including oil and gas, refining, treasury and NBFC, real estate, infrastructure, petrochemicals, etc. He additionally contributes in areas like learning and development, corporate sustainability reporting and business process management in Reliance Industries. Before joining Reliance, he was with Pricewaterhouse from 1996 to 2012. Largely, he was in auditing and accounting area, and he was before he left Pricewaterhouse, he was in charge of multi-GAAP reporting, which means Indian GAAP, US GAAP, IFRS, and he handled reputed clients like Blackstone, Hindustan Lever, DSLL, Vodafone, etc. He advised on accounting aspects to various departments, PwC, transaction advisory, audit, etc. I think this is a very illustrious biodata of Rakesh. Besides that, he has been, actively involved in the institute. He has been a board member. He was in auditing and insurance standard board of ICI. He was specially invited to accounting standard board. He has participated in development of recently issued auditing standards, accounting standards, guidance from etc. Besides this, he has very interestingly run 5 full marathon of standard category, 42 kilometers. So you can imagine he balances his work-life balance very nicely. With this, I have great pleasure in introducing Rakesh to you and request President Jackie to present the memento.
Hi, wish you all a very good morning.
Good morning.
We'll be talking on corporate social responsibility. And before I get into technicals, let me this mention starting from a base scenario. Imagine that your driver comes and asks you, I want to do chartered accountancy or law. You know that the cost of the course is hardly 20-25 or Hi, sorry. Before we go into the technical deep dive in relation to CSR and global benchmarks with respect to CSR reports, let us start with the base scenario. Imagine that you have your driver's son who says that I want to pursue chartered accountancy or IAS or law, and you find that, he is scoring some 95% in 10th and 12th. The natural reaction is, okay, please come, I'll guide. You will produce and invest 10,000, 20,000, 50,000, you will end up spending. Be it asking to persons who are conducting classes or paying the fees, so on and so forth. At that point of time, you do not have a mindset, I'll spend only 25. If I spend 25, whether it's eligible in the ATG. If I do this, whether it's eligible for my report. You just do it. The thing that we come across in our day-to-day conversation is that there are a lot of professionals coming from any background, they talk very low. They reflect very badly the profession that they come from when they are talking to senior stalwarts in an industry. They just put them very low. CSR, okay, I'll get this way. This is not a reportable expenditure. This is something that you should classify this way. Take it in the right spirit. Before we get into the deep dive, of CSR, let me mention that when we talk in industry circles, to take 4, 5, 6, 7, 10 business houses, top in the country, almost every business house have foundation, directly or indirectly. And they were already into foundation from last 8, 10 years. It's not that something that is a law today and it is being responded. Now, while the foundations were there were a lot of global standards which were already applied. If somebody wants to understand CSR, the best standard that we need to come across, and that is our road ahead, sooner or later all local standards will be either copied from global benchmarks or it will converge, evolve over a period of time to global benchmarks, and maybe global benchmarks, if you participate, they may raise their bar of excellence in certain aspects with respect to the good practices which you are already doing. So the question arises, what is the global benchmark? What we are really talking about in next 75 minutes or so, the road ahead, that is toward the end of the session for some 10 to 15 minutes, the two things that are already there, both non-mandatory. First is BRR in India, Business Responsibility Reporting. Can you all repeat the short form? BRR, Business Responsibility Reporting. That's already there. Over and above, the global principles. Whenever a meaning is unclear with respect to whatever is written in our rules, obviously we cannot refer to just only dictionary. So where we refer the literature, because rules have been published, 2 pages, 3 pages, 10 pages, that's all. So where do you refer those global principles? It is GRI guidelines, Global Reporting Initiatives Guidelines. Can you repeat that 3 words? Global Reporting Initiatives. So a framework is already there globally, and there are a lot of other frameworks which are unilateral framework on their own, but practically these are subset of global reporting initiatives. With this background, now here we will be focusing on Companies Act and the related provisions, and the things that will be covering are, first, the scope and applicability. A lot have been talked about the scope and applicability on various forums. Second, CSR spending, including how it is computed very properly. Then about the CSR committee, the composition and its duty as distinct from advisory versus execution. Then we'll talk about the board responsibility. There are a lot of questions with respect to board responsibility. The aggressive view looks nobody is fully responsible. When we look at fine prints and the general provisions, it looks like the responsibility is much wider. Then we talk about fines and penalties. Obviously, fines and penalties is not the focus of this session. If we were to focus on fines and penalties, we'll talk 1 year later, not today. About the rules, what is included, what is not included. Here I have chosen to purposely go through the verbatim reproduction. It's not that we cannot simplify or put our cases in a manner that is very catchy, but the idea is it is open to so much interpretation and thought process that it's better to take a verbatim reproduction. We'll be reading it perhaps for the first time. It's only from that limited perspective we'll spend 15 minutes on the verbatim reproduction. Then we'll be talking on issues related to CSR. These issues are what happens whenever something new comes in, which involves certain components of cost and discussion whether it needs to be included or not included. Institute generally ends up taking thought leadership positions at the beginning, and in the process they come out with certain pre-read meant for certain subcommittee members for them to enable to give the view so that it can be. So what are the views that are floating? What are the situations that are floating? And what we believe could be a fair response rather than an aggressive response. Those 7 8 situations which are widely talked about and being considered, we'll discuss point by point. Followed by the global practices as well as key takeaways. With this background, Let us look at the evolution for a couple of minutes, and that will answer most of the things that were badly or otherwise just spread by media. One of the questions that was spread by media was, why 2%? Why not 1.5%? Why not 3%? Where it came from? Initially, I will be showing you a lot of other material. Initially, way back in 2001, there was a report which was presented in Lok Sabha by an independent study group. 2011, sorry. That study group, what they ended up doing, the bureaucrats, the training institutes have a lot of material for global benchmark, and what they came across is a simple listing of top 100 companies in India. What is the profit after tax of those companies? And if 2% of that profit were to be spent, then what is the total amount that will be released from the eyes of senior corporate executives in India? In other words, there is an effective monitoring as well as brainstorming. The moment it is 1 or 2 or 3%, it is immaterial, people don't think earning out of it. If it is 40%, people think earning out of it. So they kept in their wisdom 2% in the study as a benchmark, which is light on corporate pocket. So what they came across, that even if 2% of top 100 companies, listed companies, is spent, only listed, then around 5,800 crores will be released in the system to corporate executives. But what they found was only 1,700 crores was getting released in the system. It may not be 1,700 crores, it might be 7,000 crores. But what was disclosed in the financial information, because you won't find exact classification as corporate social responsibility. What you'll find at best is donation. So to the extent that they were able to think through or pick the numbers from various official sources, they got the number of 1,700 crores. So it was felt, at least it should be. In this spirit, the bureaucrats and the lawmaker took 2% as a sanctity and went ahead without changing that number, without debating on that number, and that became a basis for discussion. Once that was done, and ministry came out with section 135 and talking about 2%, obviously there are various firms which looks at the broader picture and the current data. So one such publication that came out was from Ernst & Young, which took a data of 2,500 companies, and now they believe for the year 13-14, is taken as a base year for discussion, some $2 billion will be released in the system. That's the overall background as far as the private sector is concerned. Private and public put together to this. Over and above, there is one more CSR background which is already in existence in public sector. There is department guidelines for evaluation of public sector. Only for evaluation of performance of public sector by the ministry, there are guidelines that they should spend 5% of their net profit after tax towards corporate social responsibility. So as far as the entities within the direct control of central government, this 5% criteria for the purpose of assessment of performance of their senior management including the enterprise, this 5% criteria was already there. This was at that point of time not considered. They came to institute and asked for an opinion whether it's an obligation to spend or it is an option to spend. So without getting into technicalities, and we have those expert advisory opinion, without getting into it was considered it is an option to spend and not an obligation to spend. That opinion institute has already given in the past. Although it can be debated and there are reasons to debate that is whether it's a business expenditure or not. So there is a precedent there is an opinion which institute has already given for a similar case in the past, taking that in mind. Now, after setting the context, that is why 2%, private sector, public sector, where the threshold is 5% and not 2%. The applicability which is very widely known is any company, public or private, listed, unlisted, one person or otherwise, for all companies, if any one of the condition is applied, if any one of the criteria is applied or attracted in one particular year, then for subsequent 3 years, irrespective whether those criteria are applied or applicable or not, Section 135 will be applicable. In other words, if the net worth of the company is for any financial year is either 500 crores or more, or a profit of 5 crore or more, or a turnover of 1000 crore or more, provisions of CSR are practical. There's a lot of debate. 5 crores is just a very small amount, but it is backed by data. For unlisted company, 5 crores if a company, for a listed company when the turnover is 1000 crore or net worth 500 crores, invariably you find a profit more than 6-7% of at least the net worth. But this is not true for private companies. Private company, when you go for data analysis, if the turnover and the say if the net worth is 500 crores, there is a high chance that profit may not be even 10 crores. To capture those things as well, a lower limit of 5 crore is a welcome move from India Inc. perspective. Somebody may like, somebody may dislike. From an overall India Inc. perspective, this part is a welcome move. Anyway, they have not technically made it mandatory. Now, while we look at how the 2% is computed, now as far as the definition is concerned, the net profit criteria is after tax. But for the purpose of computing what is the suggested amount that needs to be spent, that is the suggested amount is 2% profit before tax. This is also widely known. But when I look at what income needs to be included or excluded, the adjustments are any profit, the two income that needs to be excluded from computation of that 2% are: first, if I have an income from a subsidiary, say dividend income, and on that subsidiary is anyway compliant, anyway falls under section 135, that is the provisions of CSR are applicable on that subsidiary company, whether they spend it or not accept it. If the provisions of CSR, that is not 635, are applicable to a subsidiary company, then dividends received from such company is not to be considered in computation of 2%. In computation of the gross amount on which 2% will be computed. That's first exclusion. The second exclusion is if there is a profit from outside India, of branches outside India, then to that extent that profit will be eligible. The reason could be, I say, matching concept, just to oversimplify. Because when I incur expenditure incurred outside India is not considered. Because expenditure incurred outside India is not considered, although law and logic not always be same, but in this case it is same. The same way income from outside India is not considered, it's again a thoughtful move, a welcome. If I have to look at what is the mode of spending, we'll touch in that, but before that, what are the 4 channels through which we can spend? Once you arrive at an amount that needs to be spent, the question is, what is the medium of spending, mode of spending? Now when I look at the medium of spending, these are largely into 4 buckets. out of for which 3 you follow a particular application and for 1 another application. The 4 categories are: you can incur by your own self, that is a company can directly participate on its own CSR activities, that is 1. Second, you can incur those expenses by setting up your own trust. Third, various corporate houses or companies within the same group can pool their resources together and spend it. For these 3 categories, there are no additional stipulations. So, either you incur on your own, or you incur through trust, or you pool the resources either within the same group or connecting with other groups. All 3 are welcome without additional conditions. However, when you pay such amount to an organization which is implementing CSR, then you have to necessarily ask for 2 things. First, whether that organization has a track record of maybe 3-year track record at minimum of incurring or getting into CSR activities. The word CSR activities loosely talked, but here it comes with the right when you read the fine print. The kind of CSR activity that organization will be entering into, that particular activity or that stream of activity, they should have a track record of things. It is not that somebody has registered 4 years back and they were spending some only into one category of activity, say rural development, but not into education. So if they have past record of rural development for 3 years, you cannot fund them for, say, education or urban renewal projects, because they do not have a track record. The wording is track record of similar activities. It stops. So from that context, we have to necessarily first ask whether they have a track record for similar activities. That's one. Second is, whenever such expenditure is there, because there are indirectly obligations on both the committee as well as the board, there needs to be a monitoring report from them. There needs to be a report which you need to internally generate or ask, which will satisfy the monitoring criteria or the obligation passed on the CSR as well as the board. These 2 things you have to necessarily ensure if you are getting it through third party. Else the other ways are acceptable. Now when we look at within the framework of Companies Act, there are 2 categories of executives, and it is more in the line of make-a-checker principle. One is advisory, second is executive. The advisory nature is CSR committee, and the executive nature is board of directors. I am just using general English to simplify the concepts. In terms of CSR committee, the responsibility of the CSR committee is restricted to 3 items. The 3 points are: first, they should formulate and recommend the CSR policy. So it is a formulate and recommend the CSR policy to the board. The second, they should recommend the expenditure. Third, whatever is done or being implemented by the executive, they should monitor it. So it is more in the nature of governance. It is not an executive power, it is a power which is more in the nature of governance. This is also a global practice. globally you may call stakeholder interface committee, which is a wider committee, not meant for only investor relations, it's meant for 4P, or say triple bottom line reporting from all the ends. And these are quite professional independent directors, and when you look at their CVs, it reflects something on its own. They are not coming from, grown up through internal ranks as corporate executives. So that globally, those practices are already there with those kind of names. Now, when I look at who is eligible, what is the composition of the committee of the board of CSR, there should be minimum 3 directors, out of which 1 should be independent. Now, there would be certain technical reasons that for one person company you need not have independent. So wherever there are technical limitations, those write-ups for exclusions have been made. So we need not get into those technical matters. In a sense, 3 directors, 1 should be independent. If you are not required to have a director, independent director, under the other provisions of the Act, then you need not appoint a director because of this provision of the Act, but you exclude it from it. That's the message. When I look at the board responsibility, that is executive responsibility. Board should approve the CSR policy and disclose. Disclose where? Also on website. Now there is an implication. Unpaid. When you disclose something under the Indian Trust Act, read with various judgments, and I'm again not an expert, but that has been advised to us. An unidentified beneficiary can enforce a claim on it. In other words, see, everyone's intention is genuine CSR, but there can be also adapters behavior from a segment of society. So, while you draft your policy, rather than doing cut and paste or taking from just the global practices, also have a legal vetting before you disclose that policy on your website. Reason, the beneficiaries of those policies can enforce claims. This is not technically my subject. There would be very senior persons, and if they would like to speak for a couple of minutes, elaborating the implication, in the interest of audience, I prefer to welcome them towards the end of the session. To what extent they can enforce or not enforce. But the regular that I would like to, the cautionary statement that I would like to say, have a legal vetting so that any third person cannot have it or cannot hold you for ransom. That's the limited message that I would like to pass on. Third is, the board should ensure that the activities as are included in CSR policy are undertaken by the company. Here there is a question. The question is, typically, for a first time reader or in a layman's language, if we do not spend the amount that is eligible for that is supposed to be spent on CSR, a narrow reading of the section says that you must disclose the justification why it is not spent. That's a very popular understanding, and this understanding is correct. I'll give you a reason which is generally accepted. I wanted to spend 2% of my CSR expenditure. I have given capital commitments as well. However, the project execution got delayed because the land or there was a stay order. I was opening up a school, there is a stay order. So, I could not make the spending, but I am obligated, but I will be constructing that school. So, over a period of time, that will be released. From a layman's perspective, common man's perspective, this is an acceptable thing. Imagine another reason.